Welcome, ladies and gentlemen. I'm Vijay Vaitheeswaran. I'm the Energy and Climate Innovation Editor at The Economist. And with me is Jigar Shah, Director of the Loan Programs Office at the Department of Energy. Welcome, Jigar.
Thanks for having me.
It's great to have you at such a fascinating time in the transition of the energy world. No one can say that it's a quiet life for you these days. Am I right?
It is busier than I even expected.
So let's start with the big picture. This is an extraordinary time in terms of thinking about the energy transition. We're going at the moment from the passage of the biggest climate legislation in America, certainly in recent memory, perhaps in all time, the Inflation Reduction Act, on the back of a couple of other important laws that were related to energy and infrastructure. The UN Climate Week, the Clean Energy Ministerial that was recently held, with an arc towards UN Climate Summit coming up in Egypt, the COP27 summit. So there's a lot of climate tech in the air, and there seem to be some, let's say, tailwinds after many years in which that was not the case. I remember we used to spend time during the previous clean tech boom back in the day, which ended in a clean tech bust, infamously. And so can you give us a sense of the context that you see from the 30,000-foot perspective in terms of some of the tailwinds that might be pushing forward investment coming to clean and climate technologies?
Yeah, I mean, there's a couple of different sort of perspectives here, right? One is when you think about the Copenhagen negotiations in 2009, right? And when the Secretary of State at the time had proposed a $100 billion fund to transition countries. And then you fast forward into Paris into 2015, when a lot of countries decided to cut a deal because they actually realized that this was probably the largest wealth creation opportunity of the century. And now folks are clamoring to make sure that the supply chains are in their countries. They're standing up. They're innovators. They're figuring out how to create a suite of tools necessary to make sure that the clean tech 1.0, boom to bust situation doesn't happen this time around, right? I just think that the level of sophistication around the tools that the government is using, and you start to hear, officials from the Biden administration talking about industrial strategy. These are all words around the fact that there needs to be more intentionality around how this transition occurs. And it's not just sort of, the market will get it right. It'll be fine. It's more like, no, there actually needs to be some planning because there are some, sort of friction points in the space, and things won't happen as smoothly as they could without that level of intervention. And so I think that recognition is a far different place than we were, 14 years ago.
Just to spend a moment on that, one of the reasons that the earlier wave of investment in this area didn't work out, I mean, one is technologies were less mature, obviously. We're talking more than a decade ago. That was one argument. But another is the nature of risk capital. There's a lot of venture capital that flowed in, but oftentimes there were not suitable exits. Utility customers were risk averse. You couldn't find that first contract money for demonstration projects and scale ups. What do you think the role now we have of government, of your office, but also more broadly? What have we learned, and what can we do differently? What tools are available now from public policy to fill that breach, as well as maybe some responses from first moving companies, corporates that might step in the breach as well?
Yeah, I'd say that I don't actually think that it was a inevitable conclusion that we would have had the bust in that 2014 sort of time frame. Like, I do think that technologies were worth having successful exits. I think the technologies were actually quite good back then. Obviously, they were in a more narrow set of sectors. Today, we have a more expansive set of sectors that have been supported, whether it's green cement or green steel or other places.
And we've rebranded it. It's climate tech now.
Yeah, exactly. I don't know that I could keep up with all the rebrandings, but I think that the tools that we have today, whether it's a reinvigorated loan programs office, or the Office of Clean Energy Demonstrations, which didn't exist back then, or whether it's the federal executive orders around the use of federal procurement, right? Remember, back in the 2010 timeframe, we actually had a requirement that the federal government had to buy clean vehicles. They just didn't do it, right? I think even when you think about the power purchase agreements, right, the whole virtual power purchase agreement construct that was, used by, or still is used by Google or Facebook or Amazon or Microsoft, those were active in the 2014 timeframe, right? The federal government wasn't using them, but lots of other folks are using them, right? And so I do think that the tools that we have today are the reason why this latest set of climate tech companies are going to be successful. But I think had we had those tools in 2014 and were willing to use them, then they would have actually helped all of those companies get to, relevant and gigaton scale as well.
Okay. If you lay out the case that the tools are here, I talked about some tailwinds. We do have some headwinds too, to acknowledge. The global economy is at a parlous moment. Inflation and higher interest rates are upon us. Some people talk about a venture capital winter coming. We've certainly seen SPACs in retreat, generally speaking.
I feel like there's a Game of Thrones reference in there.
Right, exactly. So I wonder, what do you think is the possibility that climate tech may actually be able to weather that coming winter for some reasons that maybe to do with policy and the flood of money coming from the Inflation Reduction Act, or Europe doubling down on green energy because of its geopolitical problems with Russia? Or some other reasons? Is there a reason to think this sector might not be affected as powerfully as some of the other sectors of early stage capital and scale up?
Yeah, it's a good question. I mean, look, I think that in my mind, for certain sectors, right, obviously all sectors are not the same. There really is a 0% chance that you're going to stop this train, right? I mean, the irreversible momentum has started, and it is moving at speed and scale. I think one of the challenges that we have in the media, I would say, is that they're focused on public markets, right? That's where the data is all very easy to find. And so they're focused a lot on, stock prices, bond yields, things like that, which of course inflation and others play a role in. And then to some degree, they're very focused on venture capital flows because there's actually some visibility there. I think where they have an enormous blind spot is infrastructure investing, right? And so when you look at the big Australian superannuation funds, the big Canadian pension funds, these folks are largely in the private transaction space, right? And so when you look at the Delta Utah project that we recently did, it was 4 of the largest, most sophisticated infrastructure investors in the world who invested in that project, right? And for them, these business cycles are irrelevant, right? Because for them, they have huge amounts of inflows from retirees or 401ks or people putting money in. And they have an allocation of dollars for infrastructure investment that makes reasonable equity rates of return that are reasonably predictable for long periods of time, right? And so
would you call that patient capital, or you see it differently?
Well, they're certainly patient capital because they're actually waiting 20 years for getting their return back, right? And so they are the ultimate holder of that paper, right? And so whereas there's a lot of intermediate owners who are, making money off the spread, right? So think the private equity firms like Carlyle or Apollo or Ares or some of those folks, they would own a project, invest in it at a 12% rate of return. But the way that they make money is by selling it down to somebody who only wants a 9% rate of return within 2 years, right? Once they've de-risked the construction and, ramped it up, they're like, oh, there's somebody else who's willing to buy it for a lower cost capital.
Right.
And I can get a high IRR because, the internal rate of return is based on how fast you get that money back, right? And so these infrastructure investors are completely different, though, and they're not generally U.S. pension funds, and so they're not well covered by the media because they're more Canadian and Australian pension funds. But the other piece of it is they're enormous, right? For them, putting in an extra $300 billion or $1 trillion into hard infrastructure tech is something that they get up every day wanting to do. Right, and so this is not something where they are, timid or, are unsure of what their criteria is. They know exactly what their criteria is, and they know exactly what a good deal is. And these are the same companies who, figured out how to securitize parking meters for Chicago, or figuring out how to do toll roads or the things, right? So they have gone into sectors that people view as esoteric for a long time, right? And so now the next generation of contracts that are now in place to sustain this kind of investment are like sustainable aviation fuel plants where Delta or United or others are offtake agreements, right? And then you've got regulation from Europe coming in saying that they're going to have to fuel with some of these biofuels if they're going to land in Europe. And so oftentimes this is mixed with technology, good contracting, which is good development, but also versions of government mandates. Right. So you see California, New York, New Jersey starting to mandate green cement in their Department of Transportation projects. Right. And so there's this sort of, I think there's
an interplay, right, between the availability of capital and, as you say, the state level requirements or mandates, a push and a pull, market creation in a way, right? Yeah.
And it's invisible to most of, I think, the press, because most of the press are reporting on this person raised $200 million from their C round, or this person is now worth $1.3 billion based on the valuation that their company got, right? But they don't generally say this wastewater treatment plant decided to build a $500 million plant using this new technology versus the old technology they would have done. That level of detail never seems to make the paper. Right. But that is what's happening in instance after instance after instance. These airport authorities are agreeing to run their entire airport off a microgrid, or they've decided to figure out a way to put in sustainable aviation fuel, or replace all of their ground transportation with, sort of hydrogen vehicles or electric vehicles. And each project feels like it's 50 million, 100 million, 200 million. But these numbers get quite big quite quickly.
Jigar, are you telling me the revolution will not be televised? Well, listen, I'm glad you're getting granular, because I wanted to dig in, and I know our audience will be interested in this as well, as a financially sophisticated crowd. Getting that bridge to bankability, as it's called, what do you see from, we all obsess over venture capital, early stage investment, but getting to the $1 billion projects and then even getting beyond that to scale up to 10 or 100 billion. Do you see technologies that are now approaching that mark? And how do you see the interplay of either what your office does or other parts of the DOE? Are you seeing private equity perhaps stepping in? Where do you see the capital coming together? And as a man formerly of the private sector, now deep in the administration of government policies, you have a unique perspective on this. So help us out here.
Yeah, so I'll go through it really quickly and then let's get into an example. I think, so the bridge to bankability has generally 4 milestones, right? So you have first of a kind deployment, you've got engineering excellence. And so in engineering excellence, this is where the EPC contractors and the other players, insurance and others, start to say, I'm comfortable with that, right? Then you start to have the learning curve, right? That's learning by doing. We've all become experts in, this curve now. And then you've got the last piece, which
Unless
I think
you're in the nuclear industry, which is forgetting by doing. Every new plant costs more than the last one.
Yes, exactly. We should get to that. And then the fourth one, which everyone forgets, is Wall Street securitization. Right? They just sort of assume that's coming. And I'd say that when you look at the solar, wind, lithium-ion battery, EV industries, that bridge to bankability took a lot longer than it needed to, right? And largely it's because the government didn't know that it was actually helping technologies cross the bridge to bankability. So they weren't being intentional about getting them across each step faster. So taking Tesla as an example, the first of a kind deployment was really when we provided the $465 million loan to build the Model S, right? I mean, the Roadster was already there, right? But actually creating the first sort of mass market car, right, was the first of a kind deployment, right? Now you had engineering excellence, right? And that was all private sector equity driven, right? You had, I think Elon went through engineering hell or scale up hell, and that was like the Model 3 and some of those other things, right? Now you get into 2019 and 2020, and even there, right, Wall Street did not believe that the collateral curve of a Tesla was predictable, and therefore you could not securitize, a Tesla, Right. And so they got down the learning curve, right? They went from, so that's stage 3. That's, I think there was roughly $77,000 average cost of their vehicles in like 2016. And now it's like somewhere in the $33,000 range, right? In terms of their cost of goods sold. And so they've gotten the cost down. They've learned by doing. They've got more automated robots and that kind of thing in there. But it wasn't until 2019, 2020 that Wall Street securitization actually said, you know what, we're going to allow some Teslas in there. And even then it was like, as long as it's less than 0.1%, right? And I would say it's only probably this year in 2022, the Teslas are fully allowed to be in those securitization portfolios, but none of the other EVs are allowed, by the way, right? So you can't put in, offerings from General Motors or Nissan or Hyundai or others in there because the Kelley Blue Book hasn't caught up in terms of what the collateral curve looks like. So if you want to go to your local bank and you want to do it yourself, you're using your own FICO score to buy it, right? But if you're a limo driving company and you own 25 limos and your law firm client has said, we're going to abandon you unless you go to all EVs, right? Which is happening regularly now. They're going to their local bank and the bank is saying, we're willing to give you 90% debt on like a Lincoln Town Car, but like, we're not sure, like if we got stuck with these cars and we took them to auction, we got our money back. So they have to put up a lot more equity, right? So all of these steps are critical to getting to full market acceptance, right? Which, by the way, comes early, right? So this is a $100 billion bridge, right? That's what it was for solar and wind and EV batteries and lithium-ion batteries and then EV manufacturing. But you got to get to $1 trillion scale to have gigaton impact.
That's
right. So you first have to get the cross-bridge bankability, get to full market acceptance, and then you have to scale.
So take me between that billion to 100 and then to the trillion that we're talking about. What do you see from the financial perspective we need to innovate further?
Well, the interesting thing is that there's no answer to the question, right? Like we just talked about nuclear for a second, right? But like you have 25 different sectors that the International Energy Agency has said that we need to be able to decarbonize the grid by 2035 and the planet by 2050. And each one of those sectors has to go from 1 billion to 100 billion to $1 trillion, right? And so hydrogen, I think we all agree is on its way, right? Geothermal, I don't know that they're on their way yet, even though we have these great new technologies in enhanced geothermal, and we're starting to do this 1,000 megawatt RFP in California for new geothermal resources. But then, it might stall there. So we have to figure out what it takes. And each one of them requires coordination between growth companies. They're the ones who the venture capitalists have given money to take a risk, right? Infrastructure investors who are like the catcher, right? They got to actually take those projects and actually agree to put the next billion in. And then the government, who has all this de-risking capital that came out of the bill and the IRA, the way in which we all dance together is different for every sector, and that needs to be coordinated. And that really is industrial strategy.
We have just a couple of minutes left. You had mentioned hydrogen in passing. It's a topic of great interest. Can you just sketch out what you think is the roadmap for hydrogen to take off in the U.S.? Obviously, the IRA law provides quite a generous amount of support. Hydrogen hubs are coming. But is this going to be primarily subsidy and policy-led, or where do you see the private sector involvement in hydrogen?
Well, look, kickstarting a sector always requires some government support. So, I think that's going to be clear. But I do think that you have 18 plus applications for hydrogen that everyone keeps touting, some of which are more fanciful than others. The ones that are earlier in the commercialization process are things like hydrogen for seasonal storage. That was that Delta, Utah project that we funded,
That's right?
You've got the Monolith Materials deal that we provided conditional commitment to, which is splitting natural gas into carbon black, which is still used in tires for electric vehicles.
Very profitably.
Absolutely. And then you have hydrogen, which then they're making into ammonia. You have a number of green ammonia projects where people are taking, wind and solar that's trapped. So the best price they can get is like $18 a megawatt hour. And they figured out if they vertically integrate into hydrogen and then ammonia, they can get to $40 a megawatt hour, right? And so you've got these business models where you already have, I think, in our estimation, roughly $30 billion worth of projects that have already been sort of either announced or are in advanced stages in the U.S. And then there's another $30 billion, I think, in Europe. And then there's more in Asia. And so, I think you're starting to get to that $100 billion number. just in those projects, right? And it's largely, I guess, in those business models that I described. The other business models, right, like heavy trucks, other things, may come in the future, but they're not the first applications that everyone's super excited about.
A final word of inspiration for the audience as they think about how to finance the climate tech revolution. What should they be thinking about?
Well, look, I think that there was a big argument in the last phase around whether we had the technologies to get to this goal of reducing carbon. Today, I think everyone agrees that we have all the technologies that we need. And the secretary talks about we need now deployment to keep up with innovation. Innovation is outpacing our ability to deploy things at scale, right? So now we have to deploy things at scale. And then I think when you think about what that looks like, there was a model post-World War II on how we all worked together to figure that out. That model has clearly like atrophied, right? And so we need to remake a model where infrastructure investors and growth companies and the government work together. And for us, right, this is the American approach to commercialization. We're talking about private sector led, government enabled, right? And I think it's critical for us to realize that the $370 billion or so that we got out of the IRA pales in comparison to the $10 trillion we need in the near term to deploy and meet all of the president's goals, right? And so, if we don't inspire 10 trillion out of the money that we're investing, then we're not going to succeed, right? And so I think there's a humility that comes from that requires all of us to work together as a team to accomplish these really ambitious and incredible goals.
Well, that's a good note to end on. Jigar Shah, thank you very much.
My pleasure.